A financial crisis does not begin with chaos. It begins with confidence. And then confidence disappears. At first, everything seems normal. Banks are lending. Markets are rising. Businesses are expanding. Then something breaks. It could be a housing bubble, a banking failure, a stock market crash, a sudden shock. When investors start doubting the system, fear spreads fast. Step 1. Asset prices fall. Stocks drop. Real estate prices fall. Investments lose value. When prices fall, people panic. Step 2. Banks become cautious. Banks survive on trust. If they fear borrowers cannot repay loans, they stop lending. This creates a credit freeze. Businesses that depend on loans struggle. Small companies cannot pay workers. Projects stop. Expansion halts. Step 3. Liquidity crisis. Liquidity means access to cash. During a crisis, everyone wants cash at the same time. Investors sell assets. Companies hoard money. Banks tighten credit. Money stops circulating. And when money stops moving, the economy slows sharply. Step 4. Layoffs begin. When companies lose revenue and cannot borrow easily, they cut costs. The biggest cost is labor. Unemployment rises. When people lose jobs, consumer spending falls. Lower spending causes more businesses to suffer. The cycle deepens. Step 5. Confidence collapses. Markets run on psychology. If people believe the future is unstable, they delay investment and spending. Fear becomes self-fulfilling. Now the crisis spreads beyond finance. Housing slows. Retail declines. Manufacturing drops. The economy contracts. At this stage, governments and central banks intervene. Central banks lower interest rates. They inject liquidity into banks. They may buy government bonds or other assets. Governments may increase spending. They may provide bailouts. They may guarantee deposits. The goal is simple: restore confidence. Because financial crises are not only about money, they are about trust. Once trust returns, lending slowly resumes. Markets stabilize. Businesses adapt. Recovery begins. But recovery takes time. Financial crises leave scars. Savings shrink. Retirement accounts drop. Businesses close permanently. However, history shows something important. Every crisis eventually ends. The Great Depression ended. The 2008 financial crisis ended. Markets recovered. But each crisis teaches the same lesson. Excessive debt creates fragility. Overconfidence creates bubbles. Lack of regulation increases risk. And fear spreads faster than logic. So how do individuals protect themselves? First, avoid excessive debt. Second, build an emergency fund. Third, diversify income sources. Fourth, think long-term. Financial crises feel catastrophic while happening. But they are part of economic cycles. They remove excess. They reset valuations. They create future opportunities. Prepared people survive crises. Overleveraged people suffer most. Understanding what happens during a financial crisis helps you stay rational when others panic. Because when money stops moving, discipline matters more than emotion.